Hey guys, Chad Rowbottom here, Embark Dallas Market President. I've got a couple of my colleagues here today. We've got Aaron Barlow and Ty Cotter. We're going to be talking about the new lease standard. A very prevalent topic in today's marketplace, specifically for both public and private companies. Private companies, still a lot of work to be done. But what we want to chat about today is some of the pain points that some companies have gone through in the past as they've worked to implement the new standard. Before we dive in, I want to let Erin introduce herself and Ty as well.
Sure, I'm Aaron Barlow. I'm a manager at Embark, and I've been here about 2 years. And I've worked on a couple of ASC 842 engagements and review others throughout the year.
Hi, my name's Ty Cotter. I'm a senior associate. I've been in Embark a little bit over a year. I get the opportunity to work on a lot of 842 engagements from start to finish. So Erin helps a lot when she reviews my work.
Teamwork.
Well, good guys. Let's just dive in, right? So if I think about the new lease standard, off the top of your head, Ty, what are some of the hurdles based on the work that you've done historically? What are some of the hurdles that companies kind of run into whenever they go to actually implement the new standard?
The most difficult part for companies is usually trying to get that complete listing of leases. So you have your major leases that you're all aware of, like your real estate leases, some of your furniture. But then where it gets difficult is the one-off copier lease in a very remote office or location. And so stuff like that. So you've got your already existing leases that you may know of, but then the ones that you don't know of. And then the second part of that is finding those embedded leases that now under 842 exist within service agreements.
Interesting. Okay. So Aaron, can you explain maybe what that means for a respective company? Like maybe give us a day-to-day example, if you will.
Sure. So the example I like to use is, as Ty mentioned, with the copier. Everybody has them, no matter what industry you're in. So under the 840, kind of the current standards for private companies, when you get your copier invoice, you just expense it. So under 842, you really need to analyze that copier invoice to see if it's really an operating lease. Under current standards, it didn't matter if you called it a service contract or an operating lease because same P&L impact, you expense both of them right away. But with 842, if it's an operating lease, you've got a balance sheet impact, and that's important. So you're probably thinking, how do I determine if that copier is an operating lease under 842? It's all about control. So you think about your copier. Can you use it as much as you want in a day? Yeah. Can you let it sit idle as much as you want? Yeah. Based on those two things, you probably have control. But the alternate side that you have to think about is can the people who own your equipment, can they come in and substitute it at any time? And if they substitute it, does that benefit the supplier? If that's the case, then you don't have control. So those are the three kind of things to think about with control. But in terms of your copier and office equipment, those are going to be operating leases.
Interesting. So that seems like a pretty robust, detailed process, right? And I think, like you said, at first, Ty, this entire process of identifying these leases can be time consuming. Do you have any best practices that companies can actually use whenever they're going through this process?
Yeah. So, I mean, your auditors are going to look through your AP ledger of what your common expenses are. So you might as well do it before them. And so my biggest thing is when I help a client implement is looking at their trial balance and looking at the account descriptions and seeing just by the name alone, does it look like that account may include a lease? And if it does, we kind of pull that down and then we get a GL detail for it. And we'll go through and we'll look at, okay, they have a recurring monthly fee in the exact amount. We might want to look into that. And so just basically doing a little bit of audit work ahead of time just to see if like, hey, this is one that, doesn't go through the normal AP process, just to find those outliers that you're unaware of. And another part of just doing the completeness testing is definitely getting in front of your business leads. So getting in front of your head of IT and saying, hey, are you aware of any IT hardware that we may be leasing, such as just server rooms, stuff like that, as well as getting in front of finance, fixed assets, and then even the procurement team, because they're aware of everything that you're buying or at least getting into agreements with. Just so not only you have the quantitative piece of the testing, but also the qualitative, like, hey, we've reached out, we've done our due diligence, and we really don't think anything else is going to pop up.
So is this different if you have kind of more centralized locations versus decentralized?
Yeah, absolutely. So, if you're a multi-site company, you may end up having to reach out to every single individual site just to see if they're aware of any. And if you think there's a high possibility, it might even come down to going on site and just taking a tour. I even suggest to some companies to walk around their office and just look for barcodes. So if they've got Xerox machines, like, is there a barcode on it? And other computer hardware that may potentially be a lease, just to add that to your completeness testing.
And are you seeing people as a result of this 842 analysis? Are they kind of keeping all these leases decentralized, or are they kind of trying to move it centralized, or are they just trying to track it centrally?
Yeah, definitely a more centralized approach, just especially if you're now implementing a new lease software, it's going to be much easier. Definitely a lot of contracts now being negotiated at headquarters instead of being a multi-site approach. Just because honestly, a lot of these companies are looking at their lease balances and are unaware that they've been overpaying for a substantial amount of assets that they don't necessarily need. So there is a cost-saving benefit to it as well, by having it centralized.
Yeah, it seems like you definitely need your kind of legal team involved in this too.
Yes, correct.
Just kind of bouncing off of that, when we keep talking about this copier, and I feel like we should just mention one more thing, and that's we've also got to take materiality into account here. So generally, you have a capitalization policy under 5,000, it's an expense. If you do your present value analysis on your copier and it's less than $5,000, you can make a policy election as a company to expense the copier. So just because the rules are changing under 842 doesn't mean that your basic GAAP accounting is changing. Well, I guess the capitalization policy is non-GAAP, but you can keep doing that non-GAAP policy.
That's a fair point. So sticking with the lease identification process, Aaron, is there anything else out there that you could think of, that you've seen in practice that might be a hurdle for a respective company?
Sure, yeah. So the big thing with the service contracts versus operating leases is, there's this expedient for 842 where you don't have to reassess your lease classification, but the caveat there is if you improperly classified it under 840, you don't get to roll forward that improper classification. So what that's causing a lot of companies to do is have to take a step back and reevaluate all of their service contracts to see if they really should have been operating leases or not. Another kind of big pain point related to these service contracts, like definitely the hot topic with 842, is what is your lease term of your service contract? Because so many of these contracts, you enter into a 3-year agreement and then it goes month to month. Or you enter into a 1-year agreement and then it's evergreen, until it exists until someone, either party, wants to terminate it. So what's your lease term? You've got to have that to calculate a present value. So there's a couple of different ways you can do it. I like to think about, I'm renting this equipment. What's the useful life of the equipment? In the past, have we kept the equipment for the whole time? Do we give it back? Is it replaced? Let's say we typically keep the equipment for 8 years. So we're going to call it an 8-year useful life. We just need to document why, the historics around it, what other people in the marketplace are doing, what asset class it would fall in if we owned it, and use that as the basis of your useful life.
That all makes sense, and it actually brings up a whole bunch of new things to actually consider, right? So in terms of the balance sheet, how does the new standard impact the balance sheet?
So the new standard's impact on the balance sheet is huge, just because all of your operating leases are going on the balance sheet now. And, we can say that all day, but what does that mean? What are your day one accounting entries? So for your day one accounting entries, you've got to gather all your inputs to calculate what your new right of use asset are going to be. So the first one is the lease term. You got to figure that out, which we just talked about. Second one is any initial costs, any upfront payments, initial direct costs. That one has some tricks up its sleeve too, because there is another practical expedient where you don't have to reassess direct costs under 840 for leases that exist under both standards. The rules were a little bit different there, so you could have some internal direct costs upfront costs that you could allocate under 840. You can't do that under 842, but there's an expedient where you don't have to worry about that. So you just got to kind of follow the rules, make sure you're getting your initial direct costs. And then the other big one is the discount rate. You've got to create a discount rate for every single new lease under 842. And that can be tricky a lot of times outside of your accounting team's skill set. But Ty, do you want to talk about the discount rate some more?
Yeah, absolutely. So the guidance calls out the incremental borrowing rate. So for public companies, that can get a little bit tricky because you could have publicly traded debt that you could use as a starting point. Some companies they're gonna have a different interest rate just depending on what their cash flow looks like. So it can get very company specific very quickly. Now, the good news is for private companies, they can elect as an accounting policy to use a risk-free rate. So that allows them to simply just go to the Treasury Department's website, look up what a rate is for whatever their lease term is, and use that as their interest rate, which saves a ton of time. But for those companies that have to use an incremental borrowing rate, it can become very lease specific, even down to like, is this real estate located in a different state? So just depending on a lot of different factors that we'd have to do a really deep dive in can affect what your rate's going to look like.
Yeah, and even adding on to that, a lot of times, private companies, they don't have publicly traded debt. You wouldn't expect them to. They might have a loan. You're like, can you just use the loan rate as your discount rate? Well, the loan is probably not for 3 years. It might be 20 years, it might be 10. And then the other part is a lot of times companies' loans are uncollateralized. And 842 specifically says you need a collateralized rate. And that just adds, another layer of complexity because your rate is going to be lower for a collateralized loan than an uncollateralized.
And the interesting thing too is just what I've seen in practice historically is that companies are not aware of that. So the discount rate is typically the last thing that they look to. And it's ultimately too late because the auditors come in and say, well, you didn't determine the discount rate in the appropriate manner. And there's a scramble at the end to get this thing right.
Yeah, changes everything.
Yeah, exactly.
Especially on a lease asset of up to, real estate adds up quickly. So you're looking at least the, $20 million gross up on the balance sheet. That interest rate will affect it quickly. So whenever we can, we strongly suggest using the accounting policy to elect just to use the risk-free rate.
There is an interesting, kind of pro con. The pro, I'm very pro using the risk-free rate. It just makes everything easier. It's broken out into all the different years. But on occasion, I've seen companies not elect to use the risk-free rate because it's typically lower and it makes the asset and the liability that they add to the balance sheet higher.
Got it.
So all these things to consider. Every company can look at their own facts and circumstances. There's a lot of ways to get to the right answer.
Okay. Well, switching gears, guys, the FASB has graced us all with some expedients for companies to actually take advantage of. But some of those practical expedients come with a few pain points. I know you touched on the expedients earlier, but Ty, like any thoughts in terms of pain points that the expedients can present to companies?
Yeah, so definitely the first one that comes to my mind is the short-term lease practical expedient. So if you have leases that are going to be 12 months or less, you can exclude them from your balance sheet and you can just account for them same way as you were under 840 and they'll go directly to the P&L. Now, the only problem with that is depending on if it's a 12-month term or a year-to-year agreement, you might have to kind of figure out, hey, are we likely to renew this? Because now it's a 2-year lease or 3-year lease, and it doesn't necessarily fall under that short-term practical expedient.
Back to the term.
Yeah, exactly. On the disclosure side of things, you still have to track those short-term leases within the disclosure of future rental payments. So making sure even if you elect to adopt the short-term practical expedient, still tracking those expenses because it will have a disclosure impact.
Yeah, I definitely recommend to my clients that they start tracking that day one so they're not in a scramble when they're putting together their year-end financials. Because, typically in your AP system, you code it with your chart of accounts and you can add a department and a company and all of that. Usually you can add another field, and so we definitely are recommending adding a field to tag them as short-term leases. So then, at the end of the year, you just download your AP data and you can filter on short-term leases and you've got your lease disclosure right there. Right. Otherwise, that's going to be a pain, especially if you have, tons and tons of invoices that you pay every month.
That's a great best practice, actually. Are there any other practical expedients that you can think of that companies might want to take advantage of?
Sure. Yeah. Another one that I think of is this is another kind of difference between 840 and 842. Under 840, your leases, especially your real estate leases, they had executory costs, and that would be your common area maintenance and your taxes and that sort of thing. So those executory costs don't exist under 842 anymore. And so now we call it, you've got your lease components and your non-lease components. But the FASB is allowing you to group your non-lease components with your lease components. You have to elect this by asset class. So if you wanted to do it for your real estate leases but not your computers, you can do that. In my experience, we always are combining the lease and non-lease components because why not? But again, it's company specific. How do you value your common area maintenance? let's just stick it with your fixed payments, but with your computers, it might be easier to put a price on the maintenance, and you might want to account for those separately.
Got it.
One thing I have noticed, and we've been speaking mostly from the lessee side, but from the lessor perspective, specifically software as a service companies, where they've got embedded leases within their revenue agreements. So they've got a hardware piece that's attached to the software. As a practical expedient, you can combine that lease and non-lease component, but depending on whether or not, which is the bigger component. So is the software the bigger piece of the contract, or is the hardware? It would either fall all under 606 or all under 842.
Got it.
So
No,
it's just something to think about.
That makes sense. So with all this in mind, whenever it comes to financial reporting, what types of software or technology are companies using to help with the implementation and streamline processes?
Yeah, well, I would just go ahead and say the number one software out there is Excel. I don't know if you've heard of it. And most of my clients have had probably less than 50 leases that we've looked at. And so Excel works for that. A workbook with 50 tabs, that's big, but not crazy. Typically, I've heard that if you have more than 50 leases, that's when you're going to want to get a software that will track them, make your journal entries, help you with your financial reporting disclosures. What have you seen, Ty?
Yeah, so I've seen multiple lease softwares. There's a ton of them out there, and depending on what size your company is, there's multiple options. But yeah, once you get over 50, it kind of becomes hard to track unless you have some dedicated fixed asset accountants on staff. So yeah, so I've seen multiple softwares out there, and depending on your line of business and your size, there's just many different strategies to overcome that. I think where that lease software really comes into play and is super helpful is when you're creating your disclosures. It's just really nice to be able to have a click of a button, and you've got your tables ready for future minimum lease payments and all that other stuff that you're now gonna have to include.
We bring up a good point on disclosures, and you guys being two Big Four auditors, can you guys tell me what you've seen in terms of how the standard has impacted footnote disclosures?
Sure. Well, I mean, the standard added an entire new footnote. So there's now, instead of just disclosing your minimum future lease payments and commitments and contingencies within the in MD&A, now within the actual body of the footnote, you've got to have a lease disclosure, and it's robust. So the guidance lays it out really well, but you've just got to hit on all of the different requirements. So we've really spent a lot of time talking about operating leases here. The capital leases are now called finance leases because got to keep you on your toes, right? Those aren't really changing, but we need to make new accounts. You need to have a separate finance lease liability account and an operating lease liability account, because one, that's so much easier to track, and two, you've got to disclose both of those. And then you've got to disclose the related right of use assets. You've got to still disclose your future cash flows related to these leases undiscounted. You've got to disclose your weighted average discount rate. The list just goes on and on. It's close to a 2 or 3 page footnote disclosure is what I've been looking at, depending on how many leases you have and how many different types of leases you have.
Ty and Aaron, thanks. Great conversation, guys. To talk about the pain points of implementing the new lease standard. You guys, thanks for tuning in. We'll be doing this more and more often. If you have any questions or concerns about the new lease standard, feel free to reach out. Look forward to seeing you guys again. Thanks.